Hello, this is Jordan, and this video is being recorded on Wednesday, July 7th, 2021. Thank you so much for joining me today. And if you're watching this on YouTube, please like, comment, and subscribe. I really appreciate it. Thank you. And in this brief video analysis, I am going to discuss a historical comparison for where the gold miners are today. And you guys know that I love doing historical comparisons and analogs. And, as we get into, or as we are in a structural bull market for precious metals, there isn't that much history to draw on. There's only the 2000s, there's only the 1960s and 1970s. So, unlike the stock market, it can be more difficult to make comparisons that are a lot more accurate. Now, there's a lot to take in on this chart, so hopefully I can run through it without confusing you or giving you too much information. And so what we have here, these are daily line charts. We have GDX at the top. We have the Huey right below it, and then we have breadth indicators. We have the 400-day moving averages for GDX and the HUI. And as far as the historical comparison, there's really two. You have the 2004 to 2005 period, and then you also have the 2016 to 2018 period. So those are two corrective periods where I see the most similarity to the current correction in the gold stocks. And the similarities, if you look at the price action, you had a significant correction in all these cases. And then also, if you look at what happened in 04 to 05, specifically look at those yellow circles, you can see that after the first move down in the Huey, it rebounded from the 400-day moving average. Then it came down, fell below it again, kind of struggled before going to a ultimate bottom. Now, if you look at 2016 to 2018, and really in 2017, there is a there's a similarity because we had this huge move up into 2016, which was pretty quick. It was only, 6 months or so, really. And, then we had a significant correction, and the market wasn't able to retrace most of the losses. And so that's similar to what happened recently, although the Huey, and you'll see in the next chart, the gold stocks, they've been a lot stronger than they were during that time at the end of 2016 and into 2017. But if you look at the 400-day moving average, where initially the rebound at the very end, the tail end of 2016, the gold stocks bounced from the 400-day, then they kind of fell back below it. And if you look at now where the GDX and HUI are, several months ago, they bounced from the 400-day. Now they're kind of, hanging around it. They're struggling. So those are just where we are today. It's similar to 2017 and also 04 to 05. Now, if we look at the breadth indicators below, using breadth indicators as oversold indicators, I am looking at the percentage of stocks in the Huey. This is my own data that have closed above the 200-day moving average. I smooth that with the 20-day moving average, as you can see. Now, when that gets down to 20%, you can have a significant bottom in the sector, as you can see. And the same thing for the bullish percent index, which I've labeled the BPI. That's just the data as is. That's also a breadth indicator. There's no smoothing mechanism there. But if that comes down close to 20%, really, if both come down close to 20%, that can mark a significant low. And then also you have the advanced decline line, which has been really weak the entire time. So that's been an issue. We need that to turn around at some point before the sector can have a sustainable low. Now, looking at, GDX, you have 30 and 29, which are the support levels. There's also the 40-month moving average. You can't see, but that points to 28. There's a gap at 27. So just remember that 30 is that was the spring low. Now, and I'll get to that. I'll continue that point in a second. But here I'm comparing the data from the Huey. This is the correction analog. Again, comparing the current correction to 0405 to 2016 to 2018. And so far, this correction, um, it's kind of followed an average between the two, but it's been stronger than the average. So this correction has been closer to the 0405 one. And if we're looking at, in terms of time, the 0405 one, that bottomed in December, whereas the 2016 to 2018 one, that didn't bottom until August. So we're looking at, based on the comparison, we're looking at, so we're in July, so we're looking at 5 months versus another year. But fortunately, as I said, based on the comparison, we're looking at a average between the two, yet we're tracking stronger than the average, which puts us closer to 0405. And another point on top of that, if you look at both those corrections, their initial low, and I think the initial low for both of those, it occurred, if we're looking at, based on the scale, the initial low occurred a while ago. Then there was a lot of consolidation. However, if you look at 0405, that initial low, it basically made a double bottom. So it didn't really undercut the initial low. And if you look at the 2016 to 2018, it did undercut the initial low, but really not by a whole lot. Once it fell below that initial low, that was basically the final decline. And that was it for the correction. So if we go back and we say, based on history, the market, maybe it's not going to go below, or maybe it only goes marginally below the initial low. And so the initial low was 30 for GDX. So I don't know. History could tell you maybe the next low is going to be at 29. Maybe it's at 28. Maybe it's a double bottom at 30. So it's just important to keep all that in mind. What we can see here and what we do know is that after the initial low, there was really a correction in terms of time, more so in time in terms of price. And that could just be something we have to deal with over the next couple months, or, even a little bit beyond that, where, yes, the market's consolidating, maybe it's trending lower marginally, but, the aspect of time where it's taking months and months for this to end, that's more significant than the price damage. So in other words, we've probably already seen most of the price damage that we're going to see for this correction, based on this historical analysis. Doesn't mean that we're not going to see, more losses potentially, but it just signals that, perhaps the bulk of the price damage has already been done. And so with that, I'm not saying it's time you want to buy everything now, but it's time to get a little bit more aggressive with your research, hone in on this stocks that are showing good value and have good fundamentals. That's what I'm doing. I added a junior producer to my watch list. I've been looking at it more in detail. It's come off its highs, and I really like the potential that it has over the next 2 or 3 years to be, a 5x, maybe a 7x if gold breaks out and goes to 3,000. So that's what I'm looking at. Love to have you join me. Go to TheDailyGold.com, get all my free info there, and consider subscribing at TheDailyGold.com/premium. Thank you so much, and I look forward to doing another video commentary in the days and weeks ahead.